Good afternoon, everyone. Thank you all for joining us this afternoon. It's a pleasure and a privilege to be here, and particularly with the panelists that we have here from around the world joining us. The topic today is about private equity and whether it's moved beyond buyouts, and I'm privileged here to have an esteemed group of panelists with me. I'll start with the ladies first, though. Huda Lawati, who is the founder and CEO of Aliph Capital. Patrick Healy right next to her, who is the CEO of Hellman and Friedman. Andrea Ponti, who's right next to me, a founder and managing partner of GHO Capital. Mustafa Siddiqui, right in the middle, who is the founder and CEO of SQ Capital. And last but not least, our first-time visitor for the region, Tong Goi, who's the chairman and CEO of China's second biggest insurance company. So it's a pleasure to be here with everybody. The title of private equity is getting a lot of popularity, both in this region and frankly globally for the longest time. And what we're seeing is there's a trend that's evolving in private equity where we're seeing a sort of, if you want, a tale of two cities. On one hand, you have funds that have grown larger and larger than ever before, over 100 billion, 200 billion, 300 billion, trillions in size, and they have a whole horde of different things underneath the overall portfolio, like the Blackstones of this world that have an infrastructure fund, a private equity fund, a credit fund, growth funds, and what have you, technology funds. So there's a whole horde of those. And then at the same time, we're seeing some private equity firms that have gone a little bit more specialized and have really grown through that specialty. And so here we're kind to discuss and kind of unpacking a little bit of all of that, as well as where AI is taking us and where this region has gone. But one of the thematics that we're seeing is that private equity seems to have peaked in 2001, where sort of the thematic around easy money and how easy it is to get the beta and how easy it is for people to perform when credit was available and a lot of funding was there and it was easy exits, et cetera. We're now in a different era. From 2003, we're seeing that more and more of the private equity firms are not getting as much exits. Maybe we're 60% below where you used to be on exits and on value creation, 63% below historics as well. So we're seeing a new evolution in where private equity is heading. And so there's no one better than to unpack all of this with the panelists that I have with me. And in particular, I mean, I'd like to start with you, Mustafa, because you in particular have yourself moved beyond the buyout. You spent many years with Blackstone and now you set up your own fund, focusing more on secondaries, which seems to be a thematic. So we're seeing a lot more secondaries happening in the overall market than ever before as a form of exit perhaps. But we'd love to hear your perspectives about where you see private equity in general and yourself in your own setup.
Sure, thank you. I think I've had the privilege of a journey that's been very interesting, as you said, starting off in traditional private equity, first growth equity and then buyouts, and then for the last many years in GP stakes, which actually first brought me into the secondaries world, but also for the first time made me a student of the industry. The industry I'd grown up in without really paying attention to it qua industry. And so I think one of the observations I would make is that finance is probably the most Darwinian industry there is, right? If you're not evolving, you're getting left behind. Assuming that you're going to achieve outsized success doing what the prior generation did is a recipe for mediocrity.
Yeah.
And so one of the observations that I had was that private equity was maturing as an industry. Today there's something like $6 trillion of private equity assets under management, close to $10 trillion of total private markets assets under management. And there's a whole ecosystem that is developing around that and needs to develop around that. And so then if you think about the liquidity side of the equation, literally only 2% of that private equity installed base turns over today in the secondary market. That is the total size of the secondary market, the total liquidity available on again, an ordinary course basis. Compare that to roughly 90% of the public equity market turns over every year. So I think that need for liquidity outside of the normal channels is really important. And then the immaturity of this space, and there are several other spaces around the ecosystem like that as well, but just put it in perspective, the 2% stat is an interesting one. When you think about the buyout space, there are roughly close to 2,000 middle market private equity firms. Our firm is focused on middle market secondaries. I can literally count on less than two hands the number of true middle market secondaries firms, which is mind-boggling, right? Yeah. The development to come in this space, in other pockets around private equity, I think there's lots of huge opportunities there.
Oh,
and,
absolutely.
and lots of, I think, the big firms and small firms are seeing that and gravitating towards that.
Yeah, no, absolutely. We're seeing more of those trends. And Andrea, maybe I'll turn over to you. And GHO is very much of a sort of focused fund as well. You've been doing that for a whole number of years as well. How are you finding the trends, and how are you looking at your own growth and development in that context?
So we started 10 years ago, more or less, very much focused only on healthcare and very much focused on the middle market in Europe. We've grown outside of Europe. We focus on transatlantic growth for European companies that want to go to the US and for US companies that want to go to Europe. That's a fantastic value inflection point. And I think that we found a very rich seam to mine in terms of transactions. That means that we don't really have to grow that much bigger and diversify. On the other hand, we see lots of very interesting opportunities to put capital to work within the healthcare ecosystem that we operate in. And that could be structured capital, it could be growth capital, it could be minorities instead of buyouts. And so I think we see a very rich future in growing within our specialty. And I think that we can continue as a result of being very focused and very disciplined to deliver very, very good returns for investors and not have to dilute them with big size and lots of different activities.
Well, that certainly seems to be more of a trend now. And perhaps, Tang, I'll turn over to you. You're managing about $30 million, let's say, of assets, and you've been a big funder and investor as an LP in many of these large private equity firms. And I'd love to understand better your perspectives as to whether you do more to the same people because they're now very diversified, or do you look at more specialty in how you allocate?
I think from our perspective at the moment, because we invest quite a bit in alternative, given we insurance background is an insurance company, our liability is very long tail, so that matches private long-term assets matches our liability. So I think it's natural habitat for us to park our capital into the long-term private assets. So we do private equity, we do credit as well, the infrastructure, the three major asset classes. I think from our perspective, I think the key criteria for us is to look for the best available managers within each of the asset class. And the criteria we apply probably, I think, is everybody does the same, but we look for stability of the team, we look for track record, and also look for the potential proper alignment of interest. So normally we pick the managers very, very discreetly, I suppose. In terms of whether you're going to go for a manager with a like a supermarket type, with a shelf of a lot of products, or the specialized fund, I think we are pretty agnostic, right? Even as a private equity, we look for the team, for the business, for the product. If that product produces long-term outsized returns, or definitely we go for it. And in addition to that, having said that, I think we also be very cognizant of the trends like AI, like healthcare. And AI healthcare probably now is in terms of sectors, the one of the two major sectors we're very focused on, trying to build our presence in these sectors. Obviously, these are, we think, we're going to have impact our future, impact our investment universe is going to be very, very meaningfully. So that's why we also focus, apart from sort of the generalist names, we also focus on AI as well. So I mean high tech as well as healthcare. Yeah, I think that's how we have a sort of trying to build a depth as well as a width of the platform.
Well, you raised something that brings me to my next sort of section of where I'd like to turn this conversation to, which is AI. And Patrick, maybe I'll start with you specifically. I mean, we've seen the thematics across, and we've heard about this morning in some of the panels earlier on, in terms of where AI is taking us, technology, the evolution of technology, and what that might entail for us for the future. And within your own portfolio companies, surely technology has been disruptive to some of it. And how have you looked at how you manage your own portfolio companies to make sure that you get the best out of your investments with regard to technology specifically?
Thank you, and thank you, Richard, and the folks from FII for having us all here. It's a significantly wonderful event. So we only have 30 companies. It's about 350 billion in market cap enterprise value, about 250,000 employees, 100 billion in revenue, and about 150 billion of our own capital, which is our own capital, about 20 billion of our own partner capital and third-party capital invested. So that's sort of the setup, and I would say 40% of what we do is software, but 100% of what we do is technology. Might be financial services, might be information services, so technology runs through it all. And that's like the key thing for us. You know, AI is, and digital has been sort of part of our mainstream. We did, print media, we did digital media. We've been having to ride these transitions. This is obviously very disruptive, but also quite powerful. So for us, AI is strategic. We've taken two partners that are on the investing side of our business. We've initiated 2.5 years ago them to be full-time on AI. We have about 10 people internally just focused on AI. Today in San Francisco, we've got 100 of our portfolio company executives, focused on the best and the latest and the greatest. And the reason is because for sure we need to be defensive about the businesses we own. Think about we own the largest contact or call center software business in the world. If you think about one industry that might be disrupted, it's that industry. So we need to be ahead of it. So we're sort of viewing AI as offensive, and we want to lean into it to help sort of fund our growth. So we've got lots of examples of efficiencies being gained by reducing costs. And Virgin Atlantic, I think now 40% of their calls, we power their call centers, are now answered by agentic agents as opposed to human capital. So that's freeing up capital, and it's allowing us to reinvest into the products. We've got lots of sort of different examples along that way. So it's very, very strategic. I'd sort of say from the investment perspective, there's a lot of industries and businesses which are sort of in a bad neighborhood from a valuation perspective because the world or the markets can't ascertain what the future might be. And so, customer care would be an area where valuations have come down significantly because of the uncertainty. So that's sort of interesting because, sort of our experience is enterprise wants to buy from enterprise as it relates to some of these bigger businesses. So strategic priority for the firm, sort of from the top down.
Great. No, absolutely. And Huda, maybe turning over to you. You've been an investor for a few decades now, but you're now particularly focused on really looking at technology and AI and how that can transform traditional businesses, particularly in this part of the world. I'd love to hear more from you about that journey and how you're seeing it, and how much have you seen adaptation? Do companies actually adopt technology proactively, and how's that working?
Great question. So it's interesting. I started my business 4 years ago, and the idea was investing in mid-market in the GCC, and we singled out digital transformation as one of the value-add levers. We're not going to not do the other things, but this needed to be singled out because it needed dedicated focus, because the return on technology, the need of technology for sustainability, and the power of disruption were very integral to our future and the future of the businesses we invest in. And within that 4 years, AI came in, and it made it even more relevant. We see it in 3 areas. One is how we operate as a manager. We're a small company. I don't have an in-house GC. Things as simple as, am I compliant with the LPA? Can I do this? Speeding up my analysis, supporting my analysts and associates to become thinkers as opposed to just, helping hands. AI has been immensely helpful, so long as they understand the downside and the hallucination risks and all of that. It's important from a diligence perspective because we can assess, is this industry, are we going to look at a call center business today or not? Are we going to do a business that is focused on people doing data mining or not? Because those businesses can become irrelevant. But the third and most impactful one is how we apply it within our portfolio companies. I'll just list a few examples of what we've done in some of our businesses to give you an idea. And I think the opportunity, given the scale we operate at as an industry, must be massive. But AI-enabled development, we have reduced in the pet shop, which is an omni-channel pet business, by 25% using AI-powered coding assistance. We implemented a tool for warehouse management system, SlimStock, and the vendor there has started using AI, which is helping us plan inventory allocation between warehouses and shops live. Sanipex is a business that's been around for 30 years. We've done multiple collections of these luxury lifestyle products, and we got Microsoft in to help us. Well, we want to benefit from our history. We're in the process of putting a local language model that will look at, historical brands, historical connection, historical clients to see how they moved and pull out from our own, intelligence from our own data that we can use for our future. Customer, obviously, the generative AI for marketing, visuals, coding, the machine learning, we're looking at customer trends, predicting churn risk, all of that we've done in the last 18 months. We also allocate, as part of our diligence, budgets and timelines for our tech roadmap very deliberately, because if you don't do that, it just comes as an additional cost. And we have reduced so much time, because one of the big projects we had in one of our businesses was data cataloging to be able to benefit from that. AI, of course, operates in chaos. So that's short. Obviously, you need some structure, so we still need to do some of it, but the timeline is reduced, the cost is reduced, so it's very impactful. But we need to play the role of making sure our portfolio companies do this. We do that. I do that as a board member in other companies, but I think that's where a lot of the challenges.
I think for sure, as a portfolio manager, there's a lot of focus and attention that needs to be done on that. And perhaps, Andrea, turning it over to you, how do you see that as an investor, manager of your own assets, and when you see technology, particularly in healthcare, taking us leapfrogging ahead, how do you see that industry being challenged by it?
So I think, like everything, change is both an opportunity and a challenge. I think in healthcare, there is a huge amount of data. In fact, I can't, maybe insurance has more data, but healthcare, there's, between the hospitals, the clinical trials, all of the regulatory information that is available about patients, about products, etc. There's an enormous amount of data that's available. One of the challenges for healthcare is actually to standardize that data, clean it, and make it usable, because I think AI is one of those garbage in, garbage out type things. If the data isn't right, then the answer is going to be wrong by definition. And so we're working quite a lot with all of our portfolio companies to make sure that the data is there.
Absolutely.
Ownership of the data is a big issue, because there's a lot of people who have patient data that never asked the patients, because 10 years ago it was never really relevant to ask anybody, can I please use all of your patient data? Now we've made a lot of progress on that. So I think that there's a lot that is happening, and there's a huge opportunity to improve and make efficiencies, reduce cost. The pharmaceutical companies have all invested heavily in it. The thing that I find, we've got a company that has some AI products that help the pharmaceutical companies become more efficient. When you go and explain that to the pharmaceutical companies, you have to go to the person who's heading the department that's going to become more efficient by streamlining and reducing their employment by 90%. For some reason, they don't want to do that. They see their budget as a percentage of the total budget as a measure of their importance, and therefore reducing their budget by 90% isn't something that they want to do. So there's a real challenge amongst the large pharmaceutical companies, et cetera, to actually bring all of these things in.
Well, it's a brand new world that we're in, and we're going to see a lot more of those challenges. But I'd like to, Mustafa, over to you. It's interesting because we're talking about how panelists are looking at AI vis-a-vis their portfolio companies or their strategies, but you've actually now changed into setting up your own company, if you would call it a PE 2.0, right? So you're entering it afresh in your own setup.
Yes.
How are you using technology? How are you adopting on technology and AI for you to do what you're doing currently?
Well, it's funny, when we launched the firm back in January, we used the adjective the first AI native secondaries firm. And because we say this, and we really mean it when we say this, that our single biggest advantage as a secondaries firm in the age of AI has been that we're a brand new firm. And the opportunity to take a blank sheet of paper without, in a sense, if you think about the incumbent challenge, with no disrespect to the incumbents, right? It's that you've got an existing factory floor. You've got to stop the factory floor, change out some of the equipment, rewire the process, retrain the people. And that's inevitably a challenge. It's surmountable, but it's a challenge. It costs money, it takes time. For us, we really had the opportunity to take a blank sheet of paper and say, okay, what would a dream secondaries investment process look like? What are all the ways in which technology can be your ally here, and 2025 vintage technology, at a time when the rate of obsolescence is so high, right? Solutions rolled out in 2023 are obsolete today. And we were fortunate we were able to attract a really world-class data science and AI team from Tiger Global and Lightspeed Ventures. So we had the right people to ideate around this and then to implement this. So that was literally has been probably the funnest part of this journey. There were moments where you almost fall out of your chair because you're sitting there daring to dream. Say, hold on a second, can we do that? Yeah, of course we can. Really? Right? And so, so what we've done is we've basically built an AI throughout our investment process, from capturing data. And remember, why is it so important in secondaries? Because secondaries is a very kind of high volume, high throughput strategy. So on the one hand, we bill ourselves as fundamental investors in secondaries, which in itself is unusual. But on the other hand, if you're going to be a fundamentals-based investor in a high throughput, high volume strategy, you need to somehow arm yourself with speed.
Yeah.
And so that's where the data science, the AI come in, allows us to move faster. To bring it to life, and this is probably the easiest of all the things we're doing, but it's the easiest also to articulate. We walk into a data room, an LP secondary data room, which has, let's say, I don't know, 30 funds and 100 PDF and Excel files, 100,000 data points across those files. We can ingest all that data in less than 90 minutes into our database in the form that our team wants to see it in, so we can immediately start running our analyses and get straight to the underwriting instead of dealing with manipulation of data.
Yeah, it's amazing.
It's incredibly
watch.
powerful.
It's
that
amazing.
would take weeks for the typical incumbent.
Absolutely. Well, thank you for that. It's amazing to watch. I can't help but bring this back now to the Middle East. So we have been used to historically seeing the Middle East being a destination for fundraising, and now we're seeing the Middle East becoming a destination for investing. Tung, maybe I'd like to start with you. This is your first trip again, but we'd love to see what are your perspectives to begin with. What would it take, and how are you looking at this region? Could it become a destination for your own investments as well?
Well, I think, it's actually my first trip to Middle East, and Riyadh is the first destination. And, for me, it strikes me as a first impression is there's quite a bit of a traffic jam when you travel. So that means there's a lot of activities. And also, second impression is the population is amazingly young. There's a lot of young people and full of energy. So that also, Saudi has quite a bit of reserve, I suppose. So it's all very good recipe for a huge, strong growth in the future if you get it right. I think that's why we're here. I'm trying to know the people, know the country, and know the region, and trying to see whether there will be any opportunities for us to invest, to be partnered with, I think. Yeah.
Well, welcome to having you here a lot more and coming in and
we'll convince you.
Yeah, absolutely, absolutely. Patrick, perhaps over to you. You've had a lot of partners from this region. You've had LPs from this region. They've been quite loyal in terms of looking at some of your investments and what you're doing. They've been co-investors with you. How are you seeing the evolution here, and what are you looking for in terms of potentially, eventually getting you to start investing over here?
Yeah, so we our first institutional partnership was 1987.
Wow.
We're now on our 11th partnership, which we closed last year. That first partnership was very much a buy and sell mentality, but starting in 1992, we sort of moved away from it's not about the deal, but it's about the business. So we've been an investment firm that whole period, and then over the last 15 years, we sort of have conjoined that with this notion of a long-term ownership mentality. So about half of the 140 billion of equity that we have in the firm has been invested for 11 years or longer. And if I go back all the way to 1987, we had actually a Saudi family as our first outside investor in that fund from the region, and then we've grown with the region since then, I think, as the region has grown in its appreciation and understanding of the asset class. And I almost think of where we're going and where the industry for private equity is going and private markets. It's almost like it's a great relationship, it's a great spouse, it's a great marriage, it's long term, it's smart, we learn a lot by talking to people in the region, and over time, it's only gotten smarter. It's patient. That's not always easy to say in a relationship. It can be challenging. It doesn't let you off the hook easy. So, and it's flexible. So as I think about, where private markets are going when, private and public start to merge and there's less of a definition, and certainly where we're going to own things longer, the flexibility to scale up, the flexibility to be strategic, not necessarily having the need to fund near-term liabilities, but compound capital over the long term. It's very, very aligned with where the industry and where we as a firm are going.
Absolutely. Thank you for that. And Huda, would love to get your perspective on how you've seen the region evolve. I mean, we over the past, let's say, decade or so, in terms of asset management as a general asset class as a destination.
Yeah, I mean, 2 decades. But listening to everyone here and all the different new products and ways of doing things, and we're barely scratching the surface. We have the benefit, of course, of leapfrogging. But I think when we started in the 2000s, we used to spend our time telling people, well, this is what private equity is, and this is what it means. I remember I went with some of the fundraising teams and to an investor in Saudi, and he said, yes, I know your bank, I have some money with you. And I'm like, no, that's not what we do. So it's come a long way. I think we had a growth phase in the early 2000s. A lot of investments were made. Then after the financial crisis, there was a lull. A lot of people were talking private equity doesn't work in the Middle East. We haven't seen returns. We haven't seen exits. In the last 5 years, we've seen so many funds come up locally, internationally. And interestingly, a lot of the international PE firms that have come here, they've come after assets that we were doing in the 2000s. Those assets have come to this space because they had a private equity investor early on in their history. And I think it just means that the private equity investment cycle was longer because we were learning. And today, with the education curve, with the opening up, with the globalization, we have a lot of tools at our hand. There's a lot to do. I've seen, since we've set up the deal flow, the capital markets, the strategics becoming acquisitive, a lot of corporates are looking at inorganic. That's helping us. Secondaries are becoming a thing. So I think there's a lot to go. We're really just scratching the surface, and I'm very, very excited. And I don't think I think the last 2 years, just the last 2 years, are probably equivalent to the 18 years that preceded.
Yeah, for sure. I'm going to leave with one last question for each and one of you to quickly answer before we wrap up. If I'm to go forward 10 years from now, where do you see your market, relatively speaking? Are you more nervous, or are you more excited about where the world is heading? Patrick, I'll start with you, and maybe we'll work our way backwards.
No, I think for sure more excited, because I think the opportunity to own things longer, compound things longer in the private markets, it's a better governance model. And I think it's, that's the way the world's going. And, I look at what the Kingdom did with Scopely and EA, like that, they can do that. Hopefully we could do something like that in the future, highly strategic, own something for long term. And I think that's where the world's going for private markets. It's exciting.
Huda?
Yeah, I'm definitely extremely excited, and I think for us as a region, we will see all these sort of different types of business models come in here, and I think we're going to have our own private equity model.
Yeah.
I'm super excited. I feel like we're sitting here in the early innings of what is the next big growth area in private markets.
Yeah.
And so I think it's, it's going to be multiples bigger than it is
Well,
today.
let me turn it a little bit different. What makes you most nervous? And we'll finish with what makes you most nervous for the rest of the...
Sure, okay. All right, so I get the hard one. So, look, I think there's a shakeout coming in the private equity industry. I think there's going to be a pretty wide dispersion of outcomes for private equity firms over the next few years. I think this idea that, it's hard to exit is a bit of a fig leaf, because it's easy. It's still, good businesses at decent prices are still eminently exitable,
Absolutely.
eminently saleable, especially in the middle market where you're not dependent on IPO markets.
Yeah.
And so I do think there's a bit of a shakeout coming. And so I think you need to be able to do your homework, pick the right, pick the right funds, pick the right GPs, pick the right assets.
Great.
And so that's how we've tried to design our firm.
Thank.
Well, I fully agree with it. 20 years ago, we believed that private is the way to go. But today, still in the future, I think private assets are still way to go. And keep on dreaming, but you need to get your feet solid on the ground.
Yeah.
Do the good work. Then you will get rewarded, I think. Yeah.
That's great. And excited and nervous. What are you?
So, In my little world of healthcare, I think we are in a bit of a golden age of discovery. There's a lot of changes that are coming from genomics, biology, immunology, precision medicine. The ability to actually now cure disease is on the table, and so that makes it hugely exciting. And our ability to invest in businesses that help bring all of those drugs to patients
That's great.
over the journey is phenomenal. And in the kingdom, for example, there is a great opportunity to build a regional leader in that space, and I think that that's something that we're all very interested and excited about. The nervous part is, I think somebody mentioned that if you sit still in private equity, you're going to be left behind.
Yes.
The market's going to continue to evolve. That's been true, to be honest, of every financial institution ever, banks, insurance companies, and I think the challenge is to continue to move in the right direction and not make the wrong
Absolutely.
moves.
Well, thank you very much for that. It's really a pleasure to have you all with us. Thank you for your expertise and your comments today, and I hope our
you.
audience appreciated the.
Thank you.
Thank you very much.
Thank you, Mei.
Thanks, Mei.